Hey, what's up guys? John here. One of the largest investors in America, Blackstone. They have $1 trillion in assets under management. They're sitting on a mountain of cash right now, getting ready to buy what? Rental houses. They're buying entry-level homes, but they're not buying yet. They're sitting on the sidelines. And I'm going to tell you why, because we're getting ready for the greatest middle-class rug pull that we've ever seen in America. I'm going to break it down for you clearly so you can see what's going on. If you're renting an apartment, maybe you own one house, you want to buy a couple others, the time to do it's going to be right in front of you. We're stepping into this massive wealth transfer, and I think the next couple of years are going to be more important than probably the next couple decades. This is going to get pretty out of hand pretty quickly. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's really going on in the economy. And if you want to fix your credit, we'd love to help you at my company, greatcreditfast.com. That's greatcreditfast.com. Go there, schedule a free strategy session. Take a look at this. Blackstone raises more than a $30 billion fund, and as I've mentioned, go on mainly rental housing, hospitality, data centers, right? Well, this is why. So over 20 million of the 50 million rental units in America are owned by mom and pops, also known as individual investors. While renters face an affordability crisis during the pandemic, with rents rising nearly 26% nationally in 2021, mom and pop landlords had their own challenges because they're getting ready. They're sitting on the sidelines, getting ready to boom, pounce on these mom and pops. And look at this. So in 2021, this is like the, Pepe, or more of like, everyone was heavily invested in Dogecoin and all these other NFTs. People were making money hand over fist, right? 44% of U.S. small businesses had less than 3 months of cash. That was at the height. They had less than 3 months of cash. Well, look at where borrowing costs are now. They went from 3% to small businesses now borrowing at 10 or 11%. Record high interest rates for these small businesses. And rumor is that they have less than 22 days of cash on hand, the average small business. And so you're looking at this, these small businesses are in big trouble. And what do these small businesses have in common? Usually a duplex or a triplex or a small office space. They have a little bit of real estate. And during this great wealth transfer, they're going to have to start selling off assets. That's what's going to happen. And they know this. Blackstone knows it. They founded Invitation Homes in 2009. They purchased 90,000 houses. 90,000 houses right off the gate. 90,000. When everyone else was afraid, everyone was scared about what's going to happen next, boom, picked up 90,000 homes. This is what they're going to do. And it's not just going to be Blackstone. Many companies are going to start doing this. Look at this. So in America, 33.2 million small businesses. So you just do the numbers here. 33.2 million small businesses. In 2021 at the height, when everyone was, in the mania, 44% had less than 3 months of cash on hand. Now it's about 20 days. So you start to look at that. 33 million small businesses sitting with less than a month of cash on hand in an economy that's going through some really big changes with record high credit card, consumer debt, auto loan debt, mortgage debt. It's a situation that's going to unfold here. Look at this. In 2022, there was 164,000 tech layoffs in America. 164,000. In 2023, 221,000 so far. And there's 5 months left of the year with 2 more rate hikes scheduled. I think this number is probably going to go maybe pick up another 150,000. So this would probably close us out somewhere around 400,000 total employees laid off by the end of the year. That's if we don't see some type of huge black swan event or anything. If this is just continuing to increase at the same velocity, that's where we're going to probably end up, somewhere around 400,000. But look at this. I mean, that'll be essentially 3 times the amount of layoffs, 3 times the amount of layoffs, give or take, of all of last year by the end of this year. And that's a problem. With car repossessions and home foreclosures rising, some Americans are living on financial cliff. Not some, most. Most people, even making $100,000 a year, are living on the edge of a financial cliff right now. Inflation's getting carried out of hand. But this is one of the really big topics right now in the real estate market that a lot of people think this is what's going to avert this massive housing crash. Look at this. The housing market's lock-in effect is very real. Just look at the map. And they're talking about people that locked in, very low interest rates, 2%, 3%. And look, if you have a 2% mortgage or 3% mortgage, hats off to you. That's incredible. That's great. But a lot of people locked in these mortgages thinking that the world was going to go back to normal. Go back to 2018, 2017 times. Everything was just going to go back to normal. They'd have these record low interest rates, record high inflation. They were basically getting free money. Who wouldn't want that? But a lot of people didn't anticipate record high inflation. They didn't anticipate record high mortgage rates, borrowing cost, just record high cost of living, home utilities going up, car insurance going up, home taxes, home insurance, everything just continuing to rise. It's impacting one's debt to income ratio, their ability to actually pay on their existing debts. It's going to be an issue. And a lot of these people that have these record high loan balances on their mortgages, it's great if they have them at 2 or 3%, but they can't refinance. And most people, they don't live in their homes forever. The average American lives in their home for about 8 years. A lot of the people locked in their rates at 2020, 2021, 2022. So what's ultimately going to happen? As the economy starts to really turn, they can't refinance because they don't have equity. They don't have the cash to do it. They don't have the income to do it. Their debt's too high. And they're in a bind. So what are they going to do? They're going to rent out their homes. They're going to walk away from their properties. They're going to bring in roommates. There's only a few options. But when you're looking at 40% of all mortgages in America taken out, during 2020 and 2021, it's a situation that should not be ignored. High mortgage rates will weigh the housing market for years. But look at this. Subprime rated consumers have less access to credit. Here's how to improve your score. Now, I've been talking about this for a while. In fact, I formed my company, Great Credit Fast, about 15 months ago and hired a team that has been in the business forever. And I did it because I'm looking at the writing on the wall saying, you know what, we're going to start seeing more defaults, we're going to see higher borrowing costs, we're going to see a changing job market, we're going to see more credit issues, and people aren't going to get access to money unless they have good credit. And that's exactly what's happening right now. We're starting to see these banks tighten up, and it's going to get worse. We're going to start to see this really get out of hand. Look at this. Out of 1.1 million listings on the market, middle-income buyers could only afford 23% of them. Think about that. 1 out of 4 houses, basically. That is crazy. But that's going to turn. That's going to change very, very quickly because we're going to start to see more motivated sellers. There's no way around it. Citadel Securities had their first half trading revenue fall by 35% so far, and profits are down nearly 60% for the first half of the year. That's the most successful hedge fund in the world, right? Citadel. You look at Ken Griffin, he made $4 billion last year, mainly due to performance of the fund. So look at this, Blackstone. They halted $71 billion from their REIT in February. Right, their $125 billion real estate fund, they were halting withdrawals. They're reducing their dividend right now to 79 cents, right? They're selling off a massive storage portfolio for $2.2 billion because they need to free up some cash. So you start to look at this, you're seeing it all over, it's all over the place. Everyone, a lot of people see it. A lot of people are like, yes, this is going to happen, no doubt. We're definitely going to be walking into a massive wealth transfer. Other people are like, no, this isn't going to happen. But you look at this. Commercial real estate experts warn vacant office space, staggering, warns we've never gone through something as tumultuous as this. Now, a lot of people don't realize that, we're stepping into something unlike anything we've ever seen before. They think that, this is basically the extent of it. No, we haven't felt this commercial real estate crisis on lending yet. We haven't felt this commercial real estate crash yet. We're going to start to see a mass mispricing of commercial assets nationwide, just large scale, mass repricing of assets. It's going to be huge. Bank regulators urge flexibility in commercial real estate loan workouts as defaults grow. That'll be interesting to try to see that. But look at this. Car insurance rates soar by as much as 40%. It's going to just continue. But look at this as well. Just for context, to show you the people with 2% mortgages, 3% mortgages that got as much as they possibly could at 2 to 3%, thinking that the economy is going to go back. Look how much just homeowners insurance has gone up in a lot of the popular states where people move to. Florida, South Dakota, Arizona. So between 2018 and 2023, homeowners insurance has increased by a cumulative 19% across 50 states. In DC, in a period, insurance premiums have risen most cumulatively in Florida, 41.5%, South Dakota, 36.8%, Arizona, 35%. We're going to see something big here. We're going to see something very, very, very big. And I think that this opportunity, it's going to be unreal. That's what I think. I think it's going to be absolutely unreal. You want to get out of high interest rate consumer debt. That should be number one priority. Getting out of high interest rate consumer debt, fixing your credit, putting yourself in a really strong position. Because when people need to start selling these assets, they need to start, repositioning themselves. The person with cash, the person with credit, the person that's positioned is going to be the one that wins. That's what's going to happen. We're witnessing the greatest wealth transfer of all time. We'll never see anything bigger than what we're seeing now. It's going to be unreal. And Jerome Powell, I think, is going to increase interest rates this upcoming meeting, and I think he's going to do it again this year, at the end of this year. And I don't think the markets are going to be able to handle it. I really don't. I don't think people are going to be able to handle it. Credit card interest rates are through the roof. It's absolutely crazy. Just looking at where they were during the Great Financial Crisis to where they are now, going from 18.1% at the height of the Great Financial Crisis to now, they say 20, 21%. But if you go look at your statement, if you have a Visa card, you have any of these major credit cards, you look at what that interest rate really is, it's 28, 29%. Some of them are even 30%. It's absolutely crazy. That's where the everyday consumer is now. Position yourself for this great wealth transfer. If you want to fix your credit, we'd love to help you, give you a free strategy session at my company, greatcreditfast.com. Go there and book a call, greatcreditfast.com. Add me on IG, and I'll catch you guys in the next video.